Nebius Group just signed tens of billions of dollars in AI infrastructure deals with Meta and Microsoft. I mean, by all logic, the C-suite should be, popping champagne, buying yachts, taking a massive victory lap.
Right, you'd think so.
But instead, the CEO just dumped millions of dollars of his own stock, and major institutions are quietly running for the exits. So today, we are tearing into the financials to figure out exactly why.
Yeah, it is easily one of the most fascinating and honestly potentially dangerous disconnects in the market right now. You have this overwhelming bullish narrative on the surface, but it's clashing directly with some terrifying financial realities under the hood.
Welcome to today's deep dive. We are looking at Nebius Group NV, ticker symbol NBIS, and we're looking at the data as of today, April 22, 2026.
And this stock has been on an absolute tear recently.
It really has. It rocketed from a 52-week low of just $21.02 all the way to a high of $168.71. So our mission today is to look at the raw data, decode the technical signals, and figure out the mechanics behind this explosive movement. We're weighing the fierce bull versus bear debate here.
Exactly, because it is fierce.
It is. And before we jump in, make sure you like this video, subscribe to our YouTube channel, and it is compulsory that you leave your feedback in the comments. We really want to know where you stand on this stock.
Let us know if you're buying or running away.
Right. And just as a quick disclaimer, we are exploring the numbers and narratives here. This is a natural debate of the data, not financial advice.
Definitely not. So the best place to start is just understanding what this company actually is right now, because the transformation here is central to the entire valuation debate. Nebius didn't just, emerge from a vacuum.
Right. This is the entity that transitioned from Yandex NV, right?
Yes, exactly. They essentially shed their previous identity as a diversified tech giant and executed this hyper-focused pivot to become a pure AI cloud provider.
They looked at the landscape, saw the AI gold rush, and basically decided they wanted to be the ones selling the pickaxes.
That's a great way to put it. And the market has certainly rewarded that pivot. I mean, their current market cap is sitting right around $40 billion.
$40 billion. Wow.
Yeah, and the last closing price was $156.55, which, was down a fraction, about 1.64% in the latest session. But when you place that $40 billion valuation next to their trailing 12-month income statement,
the disconnect becomes glaring.
Oh, totally glaring. Total revenue currently sits at just $529.8 million.
Okay, let's unpack this. Let that sink in for a second.
Yeah.
You have a $40 billion market cap on barely $500 million in revenue.
Yep.
And what about their net income?
Well, it's technically positive. It sits at $101.7 million.
Okay, positive net income sounds, reassuring on a headline.
Right.
But when you look at the balance sheet, the narrative starts to fracture really quickly.
It really does.
I mean, they have $3.68 billion in total cash, which is a solid war chest. But their total debt is already sitting higher than that at $4.89 billion.
And if you look deeper, what really stands out is the price-to-book ratio.
Right, the price to book. Where is that at right now?
It's floating between 7.95x and 8.73x, depending on the day. Yeah, and in the infrastructure space, where your core business relies on heavy physical assets, we're talking servers, cooling systems, actual data center buildings, an 8x price-to-book ratio implies the market is pricing in a massive, almost flawless wave of future growth.
Which brings us to the number that basically fundamentally breaks traditional valuation models.
Mm-hmm.
What does their free cash flow actually look like?
Oh, man. Looking at the trailing 12 months, their free cash flow is a staggering negative $3.55 billion.
Negative $3.5 billion. That is wild. It's honestly like they are ripping out the engine of a sedan and trying to install a rocket thruster while barreling down the highway.
That is exactly what it's like.
I mean, think of Nebius, like a commercial real estate developer. They've just signed Meta to a massive 5-year lease for a brand new skyscraper. But to honor that lease, they have to buy the land, pour the concrete, and build the skyscraper from scratch today.
Right, and the rent checks won't cover those construction costs for years.
Exactly. They are fronting the cash for the AI revolution. But I have to ask, how can a company with only $529.8 million in revenue and just $3.68 billion in cash possibly survive burning cash at a rate of $3.55 billion a year?
The math is incredibly strained, and it's entirely driven by their aggressive AI capital expenditure, or CapEx.
A build-out.
Yeah. To understand the cash burn, you really have to look at the mechanics of what they're actually building. They aren't just writing software. They're constructing the literal physical backbone of the AI industry.
Which means buying hardware, lots of it.
Tons it. We are talking about sourcing tens of thousands of advanced GPUs, securing dedicated power substations from the grid, and engineering these massive industrial liquid cooling facilities.
And that physical infrastructure is the core of the bull case, isn't it? Like, the reason the stock went from 21 bucks to almost 169 is because they're securing the partnerships to justify all that crazy construction.
Absolutely. The scale of these mega deals is just unprecedented. First, you have a $27 billion deal with Meta to provide dedicated AI compute capacity over the next 5 years.
So basically, Meta doesn't want the liability of building and maintaining physical data centers globally. They just want to plug in and get the compute power.
Exactly.
And Nebius takes on all the physical world risk. The construction delays, the power grid negotiations, the hardware depreciation.
That is the perfect way to look at it. They take the risk, Meta takes the compute. And it doesn't stop with Meta. They also have a $17 billion long-term collaboration with Microsoft.
That's massive, too.
And if that wasn't enough, there is a $2 billion strategic investment directly from NVIDIA to build what they are calling AI data factories.
See, that NVIDIA investment is fascinating to me, because NVIDIA is essentially funding their own customer to guarantee future GPU orders.
Yep, it's a genius move by NVIDIA.
Right. Like, they inject $2 billion so Nebius can turn around and just buy $2 billion worth of NVIDIA chips. It's a completely closed-loop ecosystem.
It is. And the bulls look at those three names, Meta, Microsoft, NVIDIA, and they just see absolute validation. If the three biggest players in the AI space are trusting Nebius with their infrastructure, the bulls argue that you simply have to spend the billions today to service those colossal contracts tomorrow.
But the bears are looking at that exact same CapEx mountain and realizing that the bridge from today's cash burn to tomorrow's revenue is incredibly fragile.
Very fragile. If we connect this to the bigger picture, the execution risk here is frankly terrifying. Nebius is planning an aggressive $16 billion to $20 billion in CapEx for 2026 alone.
Wait. Let's pause there. They plan to spend up to $20 billion in a single year.
Yes.
But they only have $3.68 billion in cash right now. That means they have a massive funding gap.
A historic funding gap. And because of these expansion costs, their EBIT earnings before interest and taxes is forecasted to remain deeply negative straight through 2026. And building a data factory isn't just about writing a check either. Nebius has a history of operational bottlenecks. In the past, they have struggled to physically meet the high demand for GPU capacity. The supply chains for these specific components are incredibly tight globally right now.
So if demand softens even a little bit, or if they face like a 6-month delay in bringing a facility online because they just can't source the right cooling manifolds,
then that massive CapEx severely strains their liquidity. I mean, they are already burning cash. If the revenue from these mega deals gets delayed by even a few quarters, they will literally run out of runway.
and what happens then?
Well, it forces them into one of two really terrible options. Either they take on toxic debt, borrowing billions in a very elevated interest rate environment, or they resort to massive shareholder dilution.
Oh, retail's favorite word, dilution.
Yeah. They'd have to issue millions of new shares to raise cash, which instantly deconstructs the value of the shares currently held by retail investors.
Okay, so if the execution risks are this high and the funding gap is this wide, how are the actual architects of this plan acting? Because if you just landed tens of billions in contracts with Meta and Microsoft, you'd expect the insiders to be holding on for dear life, waiting for that infrastructure money to print.
You really would.
But the data tells a completely different story.
Yeah, the insider activity is honestly one of the most glaring red flags in this entire financial profile. There's significant dumping happening.
We are talking about C-suite liquidation here. CEO Arkady Veloz sold roughly $3.46 million worth of his own shares on April 1st.
And that was at a price of $103.73.
Right. And then Director Elena Bunina sold about $3 million worth of shares just a couple of weeks later in mid-April.
When the leadership team is pulling millions of dollars of their own chips off the table, right as the company is embarking on its most capital-intensive expansion in history, it fundamentally undermines the bullish Wall Street narrative.
It totally does. And the smart money is following the CEO's lead, aren't they?
Oh, big time. Institutional holdings. So the massive mutual funds, the pension funds, the entities that actually move markets, they dropped by a massive 29.15% in the most recent reporting period.
Nearly a third of the institutional backing just vanished.
Exactly. A 29% drop in institutional ownership means that massive block trades and dark pool sell orders are quietly distributing shares to the public.
Wow.
The institutions have looked at that $20 billion CapEx plan for 2026, calculated the execution risk, and decided to secure their profits rather than hold through the turbulence.
But here is the massive hypocrisy of the whole situation. Despite the CEO selling, despite institutions fleeing, Wall Street analysts absolutely love it.
They do. It's so weird.
There is an 82% buy or outperform consensus among 20 different analysts.
Yeah.
The average price target sits between $165.99 and $170.29. And there's even a sky-high bull target sitting out there, 291 days.
Yeah, while the bear target is all the way down at $85.
Right. So why are analysts screaming strong buy while the CEO and institutions are running for the exits? I mean, who do you trust more, the analyst setting a $291 target or the CEO cashing out at 103 times?
It highlights a severe timeline asymmetry between Wall Street and the people actually running the company.
Timeline asymmetry. Unpack that a bit. What do you mean by that?
So an analyst at a major bank is building a 5-year discounted cash flow model. They are modeling out to 2029, assuming the Meta and Microsoft data factories are fully operational, flawless, and printing cash.
Okay, so they're looking way down the road.
Exactly. But the CEO and the institutions, they live in the present. They are looking at the next 6 to 12 months of cash burn, realizing that the company has to survive a brutal gauntlet of capital raises and construction logistics before they ever reach that 2029 promised land.
Okay, so if the C-suite is cashing out because they see the 12-month cash burn, but Wall Street analysts are holding out for the 5-year Microsoft payoff, who is actually winning that tug-of-war in the market right now?
To answer that, we really have to look at the technical analysis, because the charts are revealing a fundamental decoupling between price and momentum.
Okay, let's get into the charts.
Long term, the trend is undeniably bullish. The stock is still trading well above its major moving averages. It's trading above the 20-day, which is at $108, and the 50-day at $110, and the 200-day is way down there.
Right, so the broader trajectory over the last year is bottom left to top right.
Yes. But in the short term, the internal mechanics are flashing some serious warning signs. It's looking neutral to overbought. We look at the 14-day relative strength index, the RSI, which is sitting at 68.11.
So it's dangerously close to that overbought threshold of 70.
Exactly. But the more telling indicator is the MACD, the moving average convergence divergence.
Right, what's the MCD showing?
Well, the MACD is technically positive at 4.73, which confirms the long-term upward trend, but the indicator itself is sharply declining.
So momentum is fundamentally decoupling from the price action. Like, the stock is climbing, but the actual buying pressure behind the scenes is evaporating.
Precisely. The short-term momentum is dying. It means the upward price movement is running on fumes, mostly driven by retail traders buying the flashy AI headlines, while the institutions are quietly absorbing those buy orders with their massive sell-offs.
And this deceleration is happening right as the stock is hitting a massive wall, right?
Heavy resistance. The price is consolidating near its 52-week high of $168.71, with a solid resistance ceiling stretching up to about $170.30. Every time it approaches that level, the selling pressure just overwhelms the buyers.
So what happens if the momentum officially dies and it fails to break through that $170 ceiling? Where's the floor?
Immediate support is right around its current price at $156.54. But, and this is the scary part, because the institutions have pulled back, the order book is incredibly thin below that line.
Oh, no.
Yeah. If 156 breaks, there is a massive void. The next technical floors are a long way down. We are looking at a drop to the 50-day moving average around $110, or even down to the daily trend line at $99.92.
So you are looking at a potential 30 to 40% air pocket if that immediate support gives way.
Yeah, the volatility is really coiling up here. Buyers and sellers are trapped in this tight channel between the 156 support and 168 resistance, and a violent breakout or breakdown is imminent.
Okay, so what does this all mean? Bringing all these pieces together onto the board, we have a $40 billion valuation attached to a company burning $3.5 billion a year.
Yep.
We have historic AI mega deals, but a $20 billion CapEx requirement to actually fulfill them.
Mm-hmm.
And we have insiders cashing out while Wall Street tells retail traders to just keep buying. So Is Nebius an undervalued AI king, or is it a dangerous value trap waiting to crush retail traders?
Well, if you run traditional valuation models, the stock looks fundamentally uninvestable. Traditional discounted cash flow models literally break when a company has massive negative multi-billion-dollar cash flows.
Right, the math just doesn't compute.
Exactly, but the bulls reject the traditional models entirely. They argue that in the AI infrastructure arms race, current cash flow is totally irrelevant. To them, buying in the 150s is a perfectly fair entry point for the guaranteed revenue that will materialize in, say, 2028.
But as we discussed with the timeline asymmetry, that assumes you don't get diluted to oblivion in 2026.
That's the catch.
I mean, this setup is the textbook anatomy of a retail trap. You have high volatility and these flashy, irresistible headlines dropping names like NVIDIA and Meta. A retail trader sees that, assumes the stock is a guaranteed ticket to the AI gold rush, and they just put in a market buy order.
Happens all the time.
But they don't realize that the CEO and the smart money institutions are on the other side of that trade, happily selling them shares at a premium. Retail buys the top, expecting the stock to hit that $291 analyst target right before reality sets in.
And reality in this sector usually takes the form of a sudden capital raise to fund that massive CapEx plan, or a quarterly earnings miss that exposes all those operational bottlenecks we talked about.
So, laying out the two paths moving forward. The best-case recovery scenario for the bulls is that Nebius executes flawlessly. They navigate the GPU supply chain, build the data factories on schedule, and prove that their aggressive CapEx is turning into immediate revenue.
Right, and if they do that, the momentum flips, they smash right past that 170 resistance, and they begin the long climb toward that 291 range.
But the worst-case continuation lower is that the short-term momentum continues to bleed out. They fail to break resistance. The sheer weight of institutional selling pressure cracks that support line at $156.54, and the stock goes into a free fall, hunting for a floor around $110.
It's a high-wire act. Nebius is a $40 billion company holding the literal physical keys to major AI infrastructure, backed by the biggest tech titans on the planet. But they are bleeding cash at a terrifying rate, and the architects of the company are hedging their bets and losing institutional confidence.
They're building the future, but they're doing it with zero safety net.
Exactly zero.
And we won't have to wait long to see if they make it across the wire. The immediate horizon is right in front of us. Their next major catalyst is the earnings report, scheduled for next week, April 29th, 2026.
That earnings call is the crucible. I mean, the entire market will be parsing every single syllable the CEO says regarding their liquidity, their cash position, and the deployment of that CapEx.
The ultimate takeaway here isn't just about whether Nebius is a good or bad company. It's about timeline asymmetry. Wall Street analysts are selling retail traders on a 2028 reality, while the CEO is actively cashing out in the 2026 reality. As an investor, you don't just have to be right about the stock's ultimate destination. You have to survive the capital raises, the dilution, and the cash burn long enough to see that timeline actually play out.
That's the hardest part of investing in these growth names.
So I leave you with this hanging question to mull over. If Nebius misses their revenue projections on April 29th, even by a fraction, does that massive $16 to $20 billion CapEx plan suddenly look less like a visionary roadmap and more like an anchor dragging the stock back under $100?
It's a scary thought.
What side of the trade will you be on? Let us know in the comments. Thank you for joining us on this deep dive. Don't forget to like and subscribe, and we'll see you in the next one. Keep your eyes on the data.